Walk into any estate planning attorney's office this month and you will see the same thing. Stacks of trust folders, long intake forms, and a pitch that goes something like, "The tax exemption just dropped. If you have any assets at all, you need to act now." That pitch started in January. It picked up speed by February. By April, it had become the background noise of every financial planning conversation in America. And it is not entirely wrong. The Tax Cuts and Jobs Act did expire. The federal estate tax exemption did drop. From roughly $13 million per person down to around $7 million. That is real. That happened. But here is the part nobody is stopping to explain. At $7 million per individual, or $14 million for a married couple, roughly 95% of American households will never, not once, owe a single dollar in federal estate tax. Not your $800,000 house. Not your $1,200,000 in a 401k. Not your life insurance policy. When you add all of it up, most middle-class families are still well below the threshold. Your federal estate tax bill? $0. So why are tens of thousands of people writing checks for $5,000 or more to attorneys for irrevocable trusts they do not need? I have watched this happen repeatedly. Someone retires with $1 million in a 401k, a real, solid decades of work nest egg, and within 6 months of retirement, they have paid more to protect against a tax they will never owe than they ever spent on a family vacation. The industry knows the exemption sunset was a perfect moment. People are anxious, and anxiety sells complexity. But here is what I want you to sit with before we go any further. If you are worried about the wrong tax, you are leaving the real threat completely unguarded. The thing that is actually going to erode your family's inheritance, quietly, legally, and over the next 10 years after you die, is not the estate tax. It is sitting inside your retirement account right now. It has been there the whole time. Subscribe to this channel if you want to stop being sold to and start understanding how this system actually works. Because we are just getting started. Let me introduce you to Henry. Henry is 70 years old. He lives in Ohio. His wife passed 2 years ago, and since then, he has been quietly proud of one thing, what he is leaving behind. $1,200,000 in a traditional 401k. A house fully paid off. A daughter named Melissa, 45, who works as a project manager in Austin and earns about $100,000 a year. Henry thinks he has done everything right, and in many ways, he has. What Henry does not know is that the account he spent 30 years building is structured by federal law to hand a significant portion of it to the IRS, not to Melissa. Here is how the mechanism works. When Henry passes, Melissa inherits his 401k. Under the SE Cure Act, which has been the law since 2020 and remains in full effect, a non-spouse beneficiary like Melissa does not get to stretch that account over her lifetime the way the old rules allowed. She is required to empty it completely within 10 years. That sounds manageable. Until you run the numbers. Melissa is already earning $100,000 a year. If she pulls $120,000 per year out of Henry's 401k to drain it over 10 years, her taxable income jumps to $220,000. That pushes her from the 24% federal bracket into the 32% bracket, and that is before her state taxes in Texas, which has no income tax, actually help her. In other states, add another 5 to 9%. We are talking about roughly $300,000 to $400,000 of Henry's life savings going to the IRS instead of his daughter. Not because Henry did anything wrong, not because Melissa is careless, but because the account type Henry chose, The one every HR department defaulted him into for 30 years was never designed with inheritance in mind. It was designed to fund retirement. Passing it to a working-age child in a lump sum, forced withdrawal is a tax event that the system creates automatically. That is the mechanism. And most people do not see it until it is too late to change much. Now, you might be wondering about Roth accounts. A Roth 401k or Roth IRA that Melissa inherits still has the 10-year rule, but the withdrawals are tax-free because you already paid taxes on the way in. The difference between leaving Melissa a traditional 401k and a Roth IRA, assuming that same $1,200,000. We are talking about a gap of several $100,000 in what she actually keeps. Same account balance on paper. Very different outcome at the kitchen table. I have been close to situations where families only discovered this structure during the estate settlement process. Sitting with an attorney, going through the paperwork, and realizing the math for the first time. That moment is genuinely difficult to watch. Not because the family was careless, because nobody told them clearly. The 401k was the right tool for accumulation. It may not be the right tool for transfer. Those are two different jobs, and the account does not switch modes on its own. So you now know about the tax bomb sitting inside the inherited retirement account. And when most people hear this, the reflex is fast, get a trust, call a lawyer, do something structural. Get the assets out of the taxable account and into something protected. That reflex is understandable. It is also where the second trap closes around you. There is a specific kind of frustration that builds up in people who have done everything the right way. You worked the job, you maxed the contributions, you paid your income taxes every single year without complaint. You paid property taxes on the same house for 25 years. And now you are sitting across from a financial system that seems designed to take one more cut on the way out. That feeling is not irrational. It is not paranoia. It is a completely logical response to a tax code that genuinely does feel like it was written by people who never had to live inside it. I work in financial strategy, not psychology, but I understand completely the impulse to fight back against a system that keeps moving the goalposts. That frustration is real, and it deserves to be named before we talk about what it causes people to do. What it causes people to do is buy control, not actual control, the feeling of control. There is a difference, and the estate planning industry has built an entire revenue model around that gap. When people feel like the rules are rigged against them, the mind goes looking for something solid, something with a name on a document, something that costs enough to feel serious. A revocable living trust costs $2,000 to $4,000 at a mid-range firm. An irrevocable trust runs $5,000 to $10,000 or more, depending on complexity. These are real documents with real legal weight. They sit in a folder. They feel like a fortress. And so the internal logic goes, I would rather pay $5,000 to a lawyer than give the government one more dollar. I have heard that exact sentence more times than I can count. The problem is the math does not work that way. You pay $5,000 to the attorney, and then Melissa, or whoever your beneficiary is, still owes income tax on every dollar she pulls out of that inherited traditional 401k. Because a trust does not change the tax character of a retirement account. It does not convert pre-tax money into tax-free money. It reorganizes ownership, not tax treatment. You spent $5,000 for documentation that did not solve the actual problem. This is what researchers call reactive decision-making under threat. When people feel like something is being taken from them, they move fast and they move toward anything that feels like it restores agency. The trust industry is not predatory in a simple sense. Most attorneys are doing exactly what they were trained to do, but the incentive structure rewards selling complexity because complexity is billable and simple solutions are not. The people who get hurt are the ones who walk in already scared, already feeling like the system has betrayed them, and who sign something expensive before anyone has sat down and asked, "What problem specifically are we trying to solve here?" Most of the time, that question would reveal that probate avoidance, getting assets to your heirs without going through the court process, is the actual goal. Not tax elimination, not asset protection from creditors. Just, I want my kids to have this without a 2-year legal process eating into it. And for that specific goal, there are tools that cost nothing. They exist right now inside accounts you already own. The attorneys know about them. They just do not get paid to lead with them. Let me be direct about something I got wrong for a long time. There was a period where I genuinely believed that anyone sitting on more than $1 million in assets needed a complex trust structure. It seemed like the responsible recommendation. The math looked airtight on paper, and the attorneys who explained it were credible people. I was wrong. The complexity was solving for the attorney's invoice more than it was solving for the client's actual situation. So let us clear the air on what trusts actually do and do not do. A revocable living trust is the one most commonly sold to middle-class families. It is revocable, meaning you can change it or dissolve it while you are alive. It holds your assets on paper, and when you die, those assets transfer to your heirs without going through probate court. That is genuinely useful. Probate is slow, public, and in some states, expensive. Skipping it is a legitimate goal. But a revocable trust does not reduce your taxes. Not estate taxes, not income taxes on inherited retirement accounts. The IRS looks right through it. Everything inside a revocable trust is still considered yours for tax purposes while you are alive, and still subject to the same inherited account rules when you are gone. An irrevocable trust is a different animal. It can, in specific circumstances, remove assets from your taxable estate. But to do that, you give up ownership permanently. You cannot take the money back. You cannot change the terms without beneficiary consent. You hand control of your assets to a legal structure, and you live with that for the rest of your life. For a small number of families, large estates, complex business interests, specific Medicaid planning scenarios, that trade-off makes sense. For most people watching this video, it does not. Now meet Sarah. She lives 2 streets over from Henry. Same general situation, retired, owns her home, has a brokerage account, and an IRA she has been building for 28 years. She sat in a law firm waiting room once, looked at the intake form, saw the fee schedule, and walked out. Instead, she spent 15 minutes on the Vanguard website and added a transfer on death designation to her brokerage account. Then she called her county recorder's office and filed a transfer on death deed for her house, which is valid in most states and costs between $15 and $50 in filing fees. She added a payable on death designation to her checking and savings accounts at the bank. The whole process took 1 afternoon. When Sarah dies, her son gets the brokerage account, the house, and the bank accounts directly, automatically, without a probate filing, without an attorney, without an 18-month court process. The assets transfer on presentation of a death certificate. That is it. Compare that to the alternative. An attorney to draft and execute a revocable trust typically runs $3,000 to $7,000 upfront ante. Some charge annual maintenance fees on top of that. And if you move states, you may need to re-execute the whole thing under new state law. TOD and POD designations, $0. Sometimes a small county filing fee for the deed. That is the entire cost. The probate bypass toolkit is not a secret. It is not a loophole. It is a standard feature built into most financial accounts that most people have never been told to use. Your 401k already has a beneficiary designation form. Your IRA has one. Your brokerage account almost certainly supports TOD. Your bank supports POD. If you have not filled those out, or if you filled them out 15 years ago and never updated them, that is the single most impactful thing you can do this week. One more thing worth understanding. A beneficiary designation overrides your will completely. If your will says your assets go to your daughter, but your 401k still lists your ex-spouse as beneficiary from a form you signed in 2009, the 401k goes to your ex-spouse. The court will not fix that. The form controls. Check your accounts. Update the forms. It costs nothing, and it may be worth more than any document an attorney charges you $5,000 to produce. If you have not looked at the beneficiary designation on your 401k in the last 5 years, drop the word check in the comments. You would be surprised how many people in that situation have a form sitting on file that no longer reflects their actual family. There is a scenario that does not get talked about enough in these conversations, and it is the one that can undo everything. You have spent the last 20 minutes thinking about what happens to your assets after you die. That is the right conversation to have. But there is a parallel question that matters just as much, maybe more. What happens to your assets if you do not die, but you need serious, long-term medical care for 3, 4, or 5 years first? The average cost of a private room in a nursing facility in the United States crossed $100,000 per year in 2026. In higher cost of living states, Connecticut, Massachusetts, New York, you are looking at $130,000 to $160,000 annually. That is not a worst case number. That is the median. A 3-year stay at those rates can run $300,000 to $500,000 out of pocket. Before Medicare stops covering it, which happens faster than most people realize. Medicare covers skilled nursing care for a limited window after a qualifying hospital stay. After that, you are on your own until you spend down to Medicaid eligibility. This is where the irrevocable trust sales pitch gets particularly dangerous. The logic people are sold goes like this. Put your house and your savings into an irrevocable trust. Transfer it out of your name, and if you ever need Medicaid to cover nursing home costs, those assets will not count against you. Your family keeps the house. The government pays the bills. The problem is, federal Medicaid law has a 5-year look-back period. Every asset transfer you made in the 5 years before applying for Medicaid gets reviewed. If you moved $500,000 into an irrevocable trust 3 years ago, Medicaid sees that transfer, calculates how many months of nursing home care that money could have covered, and issues a penalty period, a window of time during which Medicaid will not pay for your care at all. You transferred the money to protect it. Instead, you created a gap in coverage precisely when you need coverage most. The math here is not abstract. If you gifted or transferred $500,000 and the average monthly nursing home cost in your area is $9,000, Medicaid divides one by the other and produces a penalty period of roughly 55 months. That is nearly 5 years during which you are responsible for your own care costs, with assets you no longer legally own and cannot get back. You gave away the money. You cannot access it. And Medicaid will not pay. That is the corner people find themselves in when the plan that sounded airtight runs into the actual rules. I have watched this happen to people who were genuinely trying to do right by their families. They were not reckless. They were scared of losing everything to nursing home costs. So they moved quickly on advice that was not wrong exactly, but was missing half the picture. The 5-year look back is not a technicality. It is a core feature of how Medicaid is administered. Any strategy that involves transferring assets out of your name needs to account for it. Specifically, whether you will need long-term care within 5 years of that transfer. And at 60, that question is genuinely hard to answer. This is why the sequencing matters. Moving assets too early because you are afraid of estate taxes you will never owe. In order to qualify for Medicaid, you may need sooner than you think, with tools that freeze your flexibility for 5 years minimum. That sequence can leave you without resources, without coverage, and without options at exactly the wrong moment. The goal of estate planning is not to minimize taxes at any cost. It is to preserve your ability to take care of yourself first, and then transfer what remains to your family as efficiently as possible. Those are two different objectives, and the industry often collapses them into one pitch. Between the inherited 401k tax bomb, the expensive trust that does not solve the right problem, and the Medicaid trap waiting on the other side of an asset transfer, what does an actual plan look like for someone in your position right now? Most people who watch a video like this feel one of two things by the end. Either they feel overwhelmed and do nothing, or they feel motivated for about 48 hours and then the folder sits on the kitchen counter until it does not. Neither of those outcomes changes anything for your family. So here are 3 concrete things you can do, in order of effort, starting with the one that takes the least time and costs nothing. Step 1. Stop worrying about the federal estate tax and start checking your state. The federal exemption is $7 million per individual. For most people reading a household net worth that includes a home, a retirement account, and some savings, the federal number is not the threat. But 12 states and the District of Columbia have their own estate taxes, with exemptions far lower than the federal threshold. Oregon and Massachusetts start at $1 million. Washington State sits at $2,193,000. If you live in one of those states and your total assets are approaching that range, the relevant tax is the one your state imposes, not the federal one. A 10-minute search for your state's estate tax exemption will tell you whether this is even a conversation you need to have. Most people will find out it is not. Step 2. Look seriously at Roth conversions while you are in a lower bracket. This is the most direct answer to the inherited 401k problem. If you are retired or semi-retired, your taxable income is likely lower now than it will be when your children inherit your account and are forced to draw it down while still working. That gap in tax rates is the window. A Roth conversion means you pay income tax now at your current rate to move money from a traditional IRA or 401k into a Roth account. Your children inherit a Roth IRA. The 10-year rule still applies. They still have to empty it within a decade, but every dollar they pull out is tax-free. The IRS already got its cut from you. It does not get another one from them. You do not have to convert everything at once. Converting enough each year to stay within your current bracket without pushing into the next one is a strategy worth running the numbers on with a fee-only advisor. The window to do this at a low rate may not stay open indefinitely. Step 3. Audit your beneficiary designations. Today, not this month. Log into every account you own, your 401k, your IRA, your brokerage account, your life insurance policy, your bank accounts. Look at who is listed as primary beneficiary and who is listed as contingent. If any of those forms are blank, list a former spouse or have not been updated since a major life event, a marriage, a divorce, a death, the birth of a grandchild. Update them now. Add TOD to your brokerage and POD to your bank accounts if they are not already in place. Check whether your state allows a transfer on death deed for real property and file one if it does. Remember what was said earlier. That beneficiary form overrides your will. The form is the plan. If the form is wrong, the plan is wrong, regardless of what any other document says. These 3 steps cost a combined total of almost nothing. A few hours across a few accounts. Maybe one conversation with an advisor if the Roth math is unclear. What they protect is the gap between what your family receives and what the IRS or a probate court takes instead. Small decisions made now, significant difference later. That is the whole game. The best financial advice for retirement is not about finding the most aggressive way to avoid taxes. It is about keeping your options open as long as possible. That is the thread running through everything covered in this video. The irrevocable trust locks you out of your own assets. The asset transfer triggers a Medicaid penalty at the worst possible moment. The inherited 401k creates a tax event nobody planned for. In every case, the damage came from moving too fast towards something complex in response to a fear that was either overstated or pointed at the wrong target. The 2026 exemption change is real. The SE Cure Act is real. State estate taxes are real for some of you. None of that is fabricated. But the solution being sold in response to all of it, expensive, inflexible, complexity first, is almost never the right fit for a middle-class household. Start with the free tools. Update the beneficiary forms. Look at Roth conversions while the window is open. Check your state's exemption before you assume the federal number applies to you. If after doing those things you still believe a trust makes sense for your specific situation, then have that conversation with a fee-only fiduciary, someone who does not earn a commission on what they recommend. That conversation will look very different from the one happening in most estate planning offices right now. Go check your 401k beneficiary designation today. Not this weekend, today. If this video helped you see through some of the noise around retirement planning in 2026, hit subscribe. That is how Wes Investor stays independent. No sponsors, no product placements, just the math and the mechanism. See you in the next one.